Welcome to vTalkInsight, Risk Sentiment Daily for April 22nd, 2026. Risk appetite is being pulled in opposite directions as a renewed Middle East energy shock and a more hawkish Federal Reserve tone collide with one of the strongest AI-led equity rallies in years. Let us unpack how that tension is reshaping today's cross-asset risk sentiment. Risk sentiment currently looks resilient, but clearly under pressure. After one of the fastest rebounds from oversold to overbought territory in decades, major U.S. indices have finally paused, with equities giving back part of their recent gains and volatility ticking higher, even though it remains well below stress levels. The mood has shifted as markets confront an acute Middle East energy shock alongside a more hawkish message from the likely next Federal Reserve chair. Even so, the fundamental backdrop that has supported risk assets is still intact. AI-linked technology, semiconductor hardware, and selected defense names continue to see earnings upgrades and benchmark-beating performance, while breadth indicators show roughly half of S&P 500 constituents and a majority of small caps recently hitting one-month highs. Financial conditions have eased markedly compared with earlier in the tightening cycle, and robust U.S. retail sales, together with still elevated profit margins in key sectors, signal that growth has not rolled over. Putting this together, the landscape looks more two-way and event-driven than outright risk-off. Prices are beginning to reflect heavier tails around energy supplies and Fed policy, yet markets are still leaning on AI-driven growth and U.S. economic leadership as buffers against shocks. That leaves positioning more vulnerable to geopolitical or policy disappointments, but also capable of re-risking quickly if there is de-escalation in the Gulf or clearer confirmation of a gentle policy path from the Fed. A central headwind for risk assets is the Middle East energy shock and supply risk. U.S. military action has severely degraded Iran's capabilities, and an effective blockade over key shipping lanes has slashed daily transits from well over a dozen vessels to just a handful, leaving an estimated hundreds of ships stranded in the Persian Gulf. This choke point around the Strait of Hormuz is constraining global oil flows, keeping a geopolitical risk premium embedded in Brent prices near the mid-90s and, at times, briefly pushing spot levels above $100. The impact is now rippling well beyond crude benchmarks. Jet fuel prices have surged, forcing airlines such as Alaska Air and United to withdraw or cut earnings guidance after fuel costs almost doubled relative to plans, even as fare increases recover only a fraction of the shock. Prolonged disruption raises the risk of fuel rationing in parts of Europe and the UK and leaves energy-dependent regions in Asia and Europe particularly exposed to both higher input costs and potential demand shocks. There are, however, some moderating signals. A ceasefire extension briefly knocked oil prices off their highs, and time spreads in crude markets suggest traders are beginning to price a partial de-escalation, with some expecting spot prices to drift back toward the 80s if shipping lanes reopen, even though damaged regional infrastructure could keep a floor under prices. For portfolios, this means energy remains a key macro swing factor. Every headline on ceasefire talks, shipping flows, or renewed strikes has the potential to reprice inflation expectations, sector earnings, and the correlation between commodities, bonds, and equities. Layered on top of the energy shock are hawkish Fed expectations and yield pressures. During his confirmation hearing, Kevin Warsh argued for a smaller balance sheet, a move towards scarce reserves, and a tougher line on inflation, framing price stability as a deliberate policy choice rather than a byproduct. Equity markets turned risk-off into the testimony, with stocks softening, Treasury yields edging higher, and the implied probability of a rate cut this year sliding toward roughly one-third. Behind the day-to-day moves lies a deeper concern that rates stay higher for longer. Long-end Treasury yields are already elevated as markets price persistent inflation risk, heavier fiscal deficits, and some gradual diversification away from the dollar, while the prospect of aggressive front-end issuance combined with constrained long-end supply raises the risk of a bear steepening. In that scenario, both bonds and equities could sell off together as discount rates rise and valuation multiples compress, with interest rate-sensitive areas such as housing and commercial real estate bearing the brunt. Yet the fixed income market is sending a more nuanced message. The 10-year yield has held close to the mid-4% area despite the hawkish rhetoric, and derivatives pricing still implies 1 or 2 cuts by year-end if inflation data cooperate. At the same time, flows into treasuries, municipal bonds, and investment-grade bond ETFs remain robust, reflecting both demand for yield and a belief that today's supply shocks will eventually normalize, even if it takes longer than once hoped. Another growing concern is stretched valuations and AI monetization risk. The recent move from oversold to overbought territory in the S&P 500 has been the fastest in roughly 4 decades, raising questions over how much good news is already in the price just as earnings season ramps up. At the same time, a pipeline of upcoming tech IPOs and a slowdown in buyback activity as companies divert more cash to mandatory capital expenditure threaten to remove important technical support for equity indices. AI intensifies that debate. Major technology platforms are committing tens of billions to AI infrastructure, often with higher leverage, on the assumption that monetization will ramp by mid-decade. But several voices highlight that if the big platforms fail to show convincing returns on this capital by around mid-2025, AI-related spending could be sharply reined in and valuations corrected. Recent cyber issues around proprietary models also underscore that the path to monetization is not risk-free. There are important offsets. Large-cap tech stocks, excluding some well-known outliers, are trading at their lowest valuation multiples in years relative to their own history, even as their growth remains strong, and investors have become more selective, rewarding clear evidence of return on invested capital rather than any AI-branded story. Still, the combination of ambitious earnings assumptions, concentrated leadership, and heavy forward spending means that disappointments from even a handful of mega-cap names could have outsized effects on index-level risk sentiment. On the supportive side of the ledger, AI-driven tech strength and earnings upgrades remain the core bull narrative. The Nasdaq 100 has logged a lengthy winning streak with cumulative gains well in excess of 60%, and a broad set of semiconductor names is outperforming as markets price a structural step-up in AI-related demand and reduce cyclicality in the chip cycle. Recent guidance suggests that S&P 500 revenue growth near 9% and earnings growth around 17% are achievable this year and into early next, with AI infrastructure spending a key driver. Capital is flowing into the ecosystem's picks and shovels. Amazon's multi-billion-dollar commitment to Anthropic underlines the long-term demand picture for cloud and AI infrastructure, while companies such as Intel are seeing upgrades and sharply higher price targets as server processors and accelerator chips become central earnings pillars. Cybersecurity players like CrowdStrike are rallying on expectations of AI-boosted demand, and corporate AI usage metrics, such as token production, have been doubling over just a couple of months, suggesting at least another year of strong deployment and monetization opportunities. That said, there are real caveats. Supply constraints, especially in memory and certain high-end components, are currently the main brake on growth, and while these bottlenecks are expected to ease over time, they can introduce volatility in quarterly numbers. Security incidents, like the recent breach of a restricted AI model, highlight ongoing intellectual property and governance risks that could weigh on sentiment if they become more frequent, even as longer-term AI adoption is expected to exert a deflationary influence on many goods and services. Beyond pure tech, a broad equity advance and easier conditions are adding resilience to risk sentiment. Around half of S&P 500 members and roughly 60% of Russell 2000 names have recently notched one-month highs, while consumer discretionary stocks show striking momentum, with the majority trading near their own short-term peaks. This breadth points to underlying confidence that the expansion is not solely dependent on a handful of megacaps. Easier financial conditions reinforce that picture. Despite policy rates remaining high, measures of overall financial tightness have eased significantly, helping to support both economic activity and asset prices. Recent corrections have seen rapid V-shaped recoveries, with resilient retail participation and systematic strategies re-leveraging quickly after volatility spikes, a pattern that has held outside of the prolonged adjustment to higher rates back in 2022. However, the strength is not uniform. European equities look more vulnerable, constrained by energy dependence and valuations that already discount an earnings recovery, leading many investors to prefer focused exposure in areas like security and semiconductor hardware over broad regional indices. Combined with thin trading volumes and ongoing geopolitical uncertainty, this suggests that while global risk assets are buoyant, the backdrop remains fragile and selective rather than unambiguously bullish. The final key support is a resilient U.S. consumer and growth leadership. U.S. retail sales in March rose close to 2%, comfortably beating expectations, and the control group, which feeds directly into GDP calculations, advanced around 0.7%, again above forecasts. These beats, alongside strong credit card travel spending and full planes despite higher ticket prices, point to consumer demand that is holding up better than many feared. More broadly, the U.S. continues to stand out relative to other major regions. A combination of innovation leadership, abundant domestic energy, deep capital markets, and generally pro-investment policy has translated into superior growth and higher market valuations compared with more energy-exposed Europe and parts of Asia. S&P 500 profit margins remain historically high in technology, financials, and industrials, even as consumer staples face more pressure from input costs and pricing power limits. Even here, the strength is uneven. A meaningful share of the retail sales growth is nominal, boosted by higher gasoline prices, and spending patterns show lower-income households tilting toward necessities as inflation erodes real purchasing power. This mix keeps stagflation risks alive, particularly if the energy shock persists. But for now, the combination of U.S. growth resilience and AI-led productivity hopes remains a crucial cushion against the more bearish forces in today's market narrative. To sum up, risk sentiment today is resilient but under strain. A severe Middle East energy shock and the prospect of a more hawkish Federal Reserve are challenging stretched equity valuations, even as AI-driven tech strength, broad participation in U.S. equities, and a surprisingly robust U.S. consumer continue to underpin the constructive case. For multi-asset portfolios, the balance of risks is shifting toward fatter tails on both sides, making developments in Gulf ceasefire talks, Fed leadership decisions, and the first wave of AI-related earnings and capital expenditure updates especially important to watch. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.